There's a financial earthquake building beneath America's banking system that's scheduled to hit in 2026. And what makes this terrifying is that almost nobody sees it coming. While everyone's focused on inflation, interest rates, and stock market volatility, a hidden crisis is meticulously assembling itself piece by piece. Bank executives know about it, federal regulators are quietly preparing for it, but the American public remains completely in the dark. I'm going to show you exactly what's happening right now in the banking sector that could trigger the most devastating financial collapse since the Great Depression. This isn't speculation. This isn't fear-mongering. This is documented fact based on Federal Reserve data, banking industry reports, and regulatory stress tests that paint a picture so alarming that when you see the numbers, you'll understand why some of the smartest people in finance are quietly positioning themselves for what's coming. The crisis has a name. It's called the maturity wall. And in 2026, that wall is going to come crashing down on thousands of American banks simultaneously. But before I show you the devastating scope of what's approaching, you need to understand how we got here and why this crisis is unlike anything we've seen before. Let me start with a story that perfectly illustrates what's happening across America right now. New York Community Bancorp was considered a stable regional bank. Solid reputation, decent management, reasonable loan portfolio. Then in February 2024, everything changed overnight. The bank announced it was slashing its dividend and revealed massive losses on commercial real estate loans. The stock price collapsed 37% in a single day, falling to a 23-year low. Depositors panicked. The bank required emergency capital injections just to survive. Here's what makes this story absolutely chilling. New York Community Bancorp wasn't an outlier. It wasn't poorly managed. It wasn't taking excessive risks. It was actually typical of thousands of regional banks across America. And what destroyed it in a matter of weeks is the exact same problem that's sitting on the balance sheets of nearly 2,000 other American banks right now: commercial real estate exposure. Those three words represent the single largest threat to the American banking system since the subprime mortgage crisis. But this time, the scope is bigger, the timeline is compressed, and the ability to contain the damage is virtually non-existent. Here are the numbers that should terrify you. According to Federal Reserve data, 1,788 banks have commercial real estate exposures greater than 300% of their total equity capital. Let me put that in perspective. If just 30% of those commercial real estate loans go bad, these banks are wiped out. Their capital is gone. They become insolvent overnight. But it gets worse. Much worse. Due to higher interest rates and the permanent shift to remote work, 14% of all commercial real estate loans are already in negative equity. For office buildings specifically, that number jumps to 44%. These aren't projections. These aren't worst-case scenarios. This is the current state of commercial real estate in America right now. And here's the part that makes 2026 the year everything collapses. Over the next 2 years, more than $1 trillion in commercial real estate loans are coming due. These loans were written when interest rates were near zero and office buildings were fully occupied. Now they need to be refinanced at interest rates that are 3 times higher for properties that are worth half as much. The math is simple and brutal. A building that was worth $100 million in 2021 might be worth $60 million today. The loan that needs to be refinanced is still $100 million. The bank has 2 choices: extend the loan and pretend the building is still worth $100 million, or force the borrower into default and realize a $40 million loss immediately. Most banks have been choosing option 1. Extend and pretend. Kick the can down the road. Hope something changes. But 2026 is when the road ends. The loans can't be extended anymore. The pretending stops. The losses become real. Barry Sternlicht, who runs Starwood Capital Group, one of the largest real estate investment firms in the world, made a prediction that should keep every American awake at night. He said regional banks will fail every day or every week, starting in 2025 and continuing through 2026. Howard Lutnick, chairman of Newmark, was even more specific. He predicted 500 to 1,000 bank failures during this same period. Think about that for a moment. 1,000 banks failing over 18 months. That's more than one bank failure every single day for a year and a half straight. And these aren't small community banks with a few million in deposits. Many of these are substantial regional institutions with billions in assets and hundreds of thousands of customers. The Federal Deposit Insurance Corporation, the FDIC, is the government agency responsible for protecting depositors when banks fail. They're supposed to step in, take over failed banks, and make sure people don't lose their money. But here's the problem. The FDIC's Deposit Insurance Fund represents only about 0.5% of the total banking system's assets. When economist Paul Kupiec was asked about the FDIC's ability to handle widespread bank failures, his response was simple and terrifying. The FDIC doesn't have that much money. What happens when the FDIC runs out of money? What happens when the agency responsible for maintaining confidence in the banking system can't fulfill its basic function? The answer is a crisis of confidence that could make 2008 look like a minor market correction. But commercial real estate is just one piece of the puzzle. There's another hidden time bomb sitting on bank balance sheets that could explode at any moment. Unrealized bond losses. During the fourth quarter of 2024, aggregate unrealized securities losses on bank balance sheets shot up to $483 billion. That's an increase of $117 billion in just 3 months. Here's how this works. When banks buy government bonds or corporate bonds, they're making long-term investments. If interest rates rise after they buy those bonds, the value of the bonds falls. The banks don't have to recognize those losses on their books as long as they don't sell the bonds. But if they're forced to sell because they need cash, those losses become real instantly. Imagine you're a regional bank facing massive commercial real estate losses. Depositors are getting nervous and starting to withdraw their money. You need cash quickly. Your only option is to sell those underwater bonds and realize hundreds of millions in losses immediately. This is exactly what happened to Silicon Valley Bank in 2023. It's what triggered the bank run that destroyed the institution in 48 hours. The Federal Reserve understands what's coming. Their 2026 stress test scenarios are designed specifically around a sharp decline in commercial real estate prices and prolonged market volatility. They're modeling the steepest yield curve in any stress test they've ever conducted. They're preparing for conditions that would be worse than 2008. When the Federal Reserve designs stress tests, they're not engaging in academic exercises. They're preparing for actual events they believe could happen. The severity of their 2026 scenarios tells you everything you need to know about what regulators expect to unfold. The timeline is clear. In 2025, $570 billion in commercial real estate loans reach maturity. In 2026, another $460 billion come due. Banks will face a choice between massive losses or extending loans on properties that can't support the debt. Either choice leads to the same destination: bank failures, depositor panic, and a cascade of collapses that could bring down the entire system. This is the crisis nobody's talking about. The hidden threat that's building systematically toward 2026. And what makes it truly dangerous is that, unlike previous financial crises, this one is predictable, measurable, and apparently unstoppable. But there's another dimension to this crisis that makes it exponentially more dangerous, something that didn't exist during the 2008 financial collapse: the shadow banking system, a parallel financial universe that operates with virtually no oversight and has grown to dwarf traditional banking in both size and risk. Right now, as we speak, there's approximately $68 trillion in assets sitting in what regulators politely call other financial intermediaries. These are investment funds, private credit companies, and financial entities that operate outside traditional banking regulations. To put that number in perspective, that's more than 3 times the size of the entire US economy. Here's where it gets terrifying. These shadow banking institutions don't just operate independently, they're intimately connected to traditional banks through a web of lending relationships that creates systemic risk on a scale never seen before. When shadow banking entities need funding, where do they go? Traditional banks. When they need to hedge their positions, who provides the derivatives? Traditional banks. When they face liquidity crunches, who serves as their backstop? You guessed it, traditional banks. The Federal Reserve recently revealed that American banks have surpassed $1 trillion in loans outstanding to non-deposit taking financial companies. That's up from $894 billion just 1 year earlier. Think about what this means. Traditional banks, already facing massive commercial real estate losses and underwater bond portfolios, have also lent over $1 trillion to institutions that operate with minimal regulation and maximum leverage. Private credit markets alone have exploded to $3 trillion in assets. These are essentially unregulated lending operations that compete directly with traditional banks, but without the capital requirements, stress testing, or oversight that banks face. They can take bigger risks, charge higher fees, and operate with more leverage because they exist in regulatory grey zones. Financial regulators are starting to sound alarm bells, but their warnings are couched in the bureaucratic language that keeps the public from understanding the true scope of the danger. The Bank of International Settlements recently stated that shadow banking has developed bubble-like characteristics that could trigger a wider global financial shock. The Financial Stability Board warned that if a crisis takes hold in private credit markets, it could ripple out to fund managers, banks, and insurers who finance the sector. What they're describing in regulatory speak is a financial contagion that would make 2008 look contained, because in 2008, the crisis was primarily centered in residential mortgages and the banks that held them. The interconnections were significant but manageable. Government bailouts, Federal Reserve interventions, and coordinated international responses eventually contained the damage. But the 2026 crisis involves commercial real estate, unrealized bond losses, and shadow banking simultaneously. 3 separate but interconnected time bombs that are all scheduled to explode within the same 18-month window. And unlike 2008, the tools that policymakers used to contain the last crisis may not work this time. Consider the Federal Reserve's position. In 2008, they had room to cut interest rates from over 5% to near zero. They could implement quantitative easing because inflation was low. They could expand their balance sheet dramatically without immediate consequences. But heading into 2026, interest rates are already elevated, inflation remains persistent, and the Fed's balance sheet is already bloated from previous interventions. The government's fiscal position is equally constrained. In 2008, federal debt was roughly 65% of GDP. Today, it's approaching 130%. The annual deficit is already approaching $2 trillion during peacetime. The government's ability to implement massive fiscal stimulus without triggering a debt crisis or currency collapse is severely limited. International coordination, which was crucial in containing the 2008 crisis, may also be compromised. Geopolitical tensions between the United States, China, and Russia have reached levels not seen since the Cold War. The European Union is dealing with its own banking sector, stress and commercial real estate problems. Central bank cooperation that helped stabilize global markets in 2008 cannot be taken for granted. This brings us to the most chilling aspect of the approaching crisis, the speed at which it could unfold. Modern banking operates on confidence and digital transactions that move at the speed of light. When depositors lose confidence, they don't have to visit physical branches to withdraw their money. They can transfer millions with a few clicks on their smartphones. Silicon Valley Bank collapsed in 48 hours, not weeks, not months. 48 hours from the first signs of trouble to complete failure. And that was just one bank facing one specific problem. Imagine what happens when hundreds of banks simultaneously face commercial real estate losses, forced bond sales, and depositor runs. The interconnected nature of modern finance means that problems spread faster than they can be contained. A bank failure in Ohio immediately affects correspondent banks in Texas. A commercial real estate default in New York triggers margin calls for private credit funds in California. A shadow banking liquidity crisis in London impacts derivative markets in Chicago. We're looking at a financial system that's more leveraged, more interconnected, and more fragile than it was in 2008, facing multiple simultaneous crises that are larger in scope and more difficult to address. The tools that worked last time may not be available or effective this time. And perhaps most importantly, the American public is completely unprepared. Most people assume that deposit insurance protects them completely. They don't understand that the FDIC's resources are limited. They don't realize that bank failures can freeze access to funds for weeks or months, even when deposits are ultimately protected. They have no concept of how quickly the financial system they depend on could simply stop functioning. The warning signs are everywhere for those who know how to read them. Bank executives are quietly raising capital and reducing risk exposures. Sophisticated investors are increasing cash positions and seeking alternative stores of value. Financial institutions are stress testing for scenarios that go far beyond regulatory requirements, but the general public remains focused on daily market fluctuations, political drama, and economic statistics that provide no insight into the structural problems building beneath the surface. The 2026 crisis won't announce itself with obvious warning signs. It will arrive suddenly, seemingly out of nowhere, catching millions of Americans completely off guard. The mathematics are inexorable, the timeline is established, the interconnections guarantee that when the crisis begins, it will spread faster and farther than previous financial collapses. What remains unknown is whether there's still time to prepare for what's coming, and what that preparation should look like for ordinary Americans who will bear the consequences of decisions made by others in boardrooms and regulatory offices they'll never see. Never see. The question isn't whether this crisis will happen. The question is what you can do about it before it's too late. Because once the dominoes start falling in 2026, the window for protection closes permanently. And understanding what's coming gives you an advantage that 99% of Americans won't have. Let me show you exactly how this will unfold and what it means for your money, your savings, and your financial future. The sequence is predictable because it follows the same pattern every financial crisis has followed throughout history. First comes the recognition phase. Banks will be forced to acknowledge their commercial real estate losses. These won't be gradual write-downs spread over years. There'll be massive quarterly hits that immediately call into question the solvency of entire institutions. We're already seeing the early stages of this recognition. Regional banks are quietly extending loan terms, renegotiating payment schedules, and doing everything possible to avoid marking their commercial real estate portfolios to current market values. But this strategy has an expiration date. Loan covenants have limits, regulatory requirements have thresholds, auditors have standards. Eventually, the losses must be acknowledged. When that recognition phase accelerates through 2025 and into 2026, it triggers the confidence phase. This is when depositors, creditors, and counterparties begin questioning which banks are truly solvent and which are walking zombies, propped up by accounting gimmicks. The confidence phase moves at digital speed in our modern banking system. Consider what happened to Credit Suisse in March 2023. For months, analysts and regulators insisted the bank was adequately capitalized and fundamentally sound. Then rumors began circulating about liquidity problems. Within days, depositors were pulling billions. Within weeks, the bank was gone. Absorbed by UBS in a government-orchestrated fire sale that wiped out shareholders and bondholders, Credit Suisse was a global systemically important bank with sophisticated risk management and regulatory oversight. If it could collapse that quickly, imagine how fast regional banks with concentrated commercial real estate exposure will fall when confidence evaporates. The liquidity phase comes next. Banks facing deposit outflows need cash immediately. They can't wait for loans to mature or properties to sell. They must liquidate whatever assets they can convert to cash quickly. This means selling those underwater government bonds at massive losses. It means calling in credit lines to shadow banking entities. It means reducing lending to businesses and consumers who depend on credit for daily operations. But here's where the 2026 crisis becomes truly unprecedented. The sheer number of banks facing simultaneous liquidity crunches will overwhelm the traditional mechanisms for managing bank failures. The Federal Reserve's discount window, where banks can borrow emergency funds, isn't designed to handle hundreds of institutions seeking billions in financing simultaneously. The FDIC's standard operating procedure involves taking over failed banks on Friday afternoons, spending the weekend restructuring operations, and reopening them Monday morning under new management or merged with healthy institutions. But what happens when there aren't enough healthy institutions to absorb the failures? What happens when the FDIC faces 50 bank failures in a single weekend instead of one or two? The contagion phase is when individual bank problems become systemic financial crisis. Modern banking operates on interconnected relationships that create cascade effects. When Bank A fails, it can't repay its obligations to Bank B. Bank B suddenly faces unexpected losses that threaten its own solvency. Bank C, which had lending relationships with both institutions, faces credit losses that force it to restrict lending to its customers. These cascade effects don't respect geographic boundaries or institutional types. A commercial real estate default in Miami affects a regional bank in Ohio that provided construction financing. That bank's failure impacts a credit union in Colorado that held correspondent deposits. The credit union's problems affect a community bank in Montana that relied on those deposits for liquidity management. Multiply this interconnectedness across thousands of institutions and trillions in exposures, and you begin to understand how localized problems become national crises. The financial system's complexity, which provides efficiency and innovation during normal times, becomes a vulnerability amplifier during stress periods. The policy response phase is where things get truly terrifying, because unlike 2008, policymakers will face impossible choices with limited tools. The Federal Reserve could cut interest rates to support banks and borrowers, but that risks reigniting inflation that's already proven persistent. They could implement quantitative easing to provide liquidity, but their balance sheet is already stretched and markets might interpret new money printing as desperation rather than strength. The government could announce deposit insurance increases or bank bailout programs, but the fiscal deficit is already approaching $2 trillion annually. Adding hundreds of billions in bank support costs could trigger questions about government solvency and dollar stability. International investors might begin questioning whether the United States can honor its financial commitments. The numbers don't lie, the timeline is set, the interconnections are mapped. What we're looking at isn't a possibility anymore, it's a mathematical certainty unfolding exactly as the data predicted it would. You now know what the smart money has known for months. You understand what bank executives discuss behind closed doors. You've seen the regulatory stress tests that model scenarios worse than 2008. The question that matters now is simple. What are you going to do with this knowledge? Because when 2026 arrives and the dominoes start falling, there won't be time to prepare. There will only be time to survive.